Welcome to Subramani. This is continuing my investment learning, and I'm going to talk to you about my risk strategy, risk and portfolio building strategy. So, portfolio construction and portfolio weightage is something which I learned from Naren, because otherwise I would just go and buy some shares and say very good. Now what I do is I bravely put 1% or 2% or maybe 3% of my portfolio, and then I keep buying. So I will let the concentration run to as high as 17-18% without worrying too much, saying anyway it's a good share, I bought it at a low cost, so let me enjoy the fun. So portfolio sizing is something which I learned from Naren, and I implemented it. So I'm happy that I implemented it. So I have a better quality construction of my portfolio. Instead of a very long portfolio, my portfolio has got shorter. I take all the risk in equity. So if you tell me here is a fund which will give you 12% IRR in debt, I'm not too keen, because debt is something where I consider, like yesterday also I was telling somebody, is 1% extra return and 99% risk. It's not worth it. For me, the risk reward ratio in debt is not worth it. My debt is in very, very safe places. It could be like a savings bank account or a liquid fund or an ultra short bond fund, and I don't take risk in my portfolio, and I hope my future fund managers whom I allocate don't take risk, because we all have had one bad experience. So all the risk in my portfolio comes from the equity portion. My short-term money is obviously in cash or ultra-short bond funds kind of places. And in the long term, I take risk. It could be a Japan fund, Brazil fund, China fund. It could be a fund of funds. It could be a thematic fund. I do all that, and I also do direct equity. In fact, direct equity could be 80-90% of my portfolio. So for me, portfolio construction, portfolio sizing is important. I can just keep doing SIPs and funds without worrying too much, but fairly obviously I do that also. But largely I'm a direct equity guy, and I take all my risk in direct equity. Timing for me has become pretty irrelevant, because I have done let's say dollar cost averaging, rupee cost averaging, whatever you want to call it, over very long periods of time. I have held on to shares for 40-45 years. So when you hold on to some share for 45 years, I mean, pricing becomes irrelevant. At whatever price my mother sells off her Colgate shares, it is irrelevant, because her cost could be a few paise, 1 paise, 2 paise kind of things, thanks to the bonuses and all that splits and bonus that one gets. So for me, timing is become irrelevant simply because of the long time that I have held it for. So a lot of my portfolio is boring. You will have your Colgate and HUL and HDFC Bank, pretty dull, pretty boring, but no surprise portfolio, right? So 50-70% of my money could be in such funds, maybe more than 70% could be in such funds. So they're dull, they're boring. That's something which I don't have to think. I don't have to worry about, oh, this quarter PNG did better than Gillette, or Gillette did better than Colgate. To me, it doesn't matter. All three are in my portfolio. There are long periods of time when their performance has been pathetic, long times when short times when the performance has been fantastic, right? So these things will happen, and that I am not bothered. Like I said, timing has not mattered, whether in terms of buying or in terms of holding. It's been held for a very long period. So that portion of my portfolio is very boring, and that could be, I've not actually done a boring and not so boring portion of my portfolio, but that could be upwards of 70% also, right? So some high size upsides which I got, because Franklin Templeton had a fund manager who used to run a technology fund, and he took a lot of he took risk, and I enjoyed that risk, and I benefited by that. So I took hints from him and did. In fact, he was doing exactly what I was doing. He was building a positions in Zomato when I was also building positions in Zomato. I enjoyed that process. So some of these higher risk with perhaps higher return or perhaps a loss. Indigo was once a share. Indigo is now, I think, a more stable company. So some of these shares I built position from a low base. Zomato, I think I started at 47 or something when Ashwath Damodaran said it could go lower. I said that's enough. I don't want much more greed. Same thing with Paytm. I started building position much after the crash had happened. So some of these opportunities came their way. So some high side bets would be there, but by the time I look at them, they have become part of my boring portfolio. Indigo has now become part of my boring portfolio, but it's something which I would still keep watching. I'm not recommending it for people. It's going to be a very volatile stock over the next few years. But yes, if it continues to increase its foreign passenger or foreign destinations and flies more foreign, which means it's spending more in rupees and earning in dollars, it will continue to do well. But yeah, it's now already a portion of it is at least boring. It's not that it was not that 800 rupee share which I bought in 2020. That time it was higher risk, but at 5,400, I think it's a dull, boring part of my portfolio. And you can't have infrastructure without having airline. That kind of an argument. Should I have more checklists? I agree that, but a fund manager goes through checklists much better than I do. I don't have checklists, but I have very quick rejection for people whom I don't trust. So those some of those things which I would not even touch such promoters. So some of those things could happen. And what else do I have to do as in portfolio strategy? Let me just look at some of the notes that I have made. Getting more checklists, getting more watch lists, journals, reading, talking. I go out to events to meet people where I hear murmurs about something. So some companies I have built portfolio. Wealth management is not a business which you can ignore for too long. Banking is not a business you can ignore for too long. You may or may not like the business, but these businesses make money. Hospitals is not something which you can ignore too long. So I made money in hospitals, I made money in banking, I made money in wealth management, but now I don't know whether they're fully overpriced or overly overpriced. So I don't know. So some of these strategies may work for you, some of the strategies may not work for you. And let's get to some wealth building, very, very basics. You have to have a very good savings in your initial stages. The percentage of money that you're saving is far more important than the percentage of return you're getting on your capital, because you don't have much capital, right? Control your controllables. If you're a young person, control how much you're eating out, how much you're spending on travel and those kind of things. Control all that and start doing an SIP. Start investing. That is very important. Don't take credit. Learn to live within your means, right? So those are things which are important. Rebalancing may be important. You may have to have debt in your portfolio simply because you're supporting a lot more people. You cannot have a 100% equity portfolio just because your colleague has. Your colleague may come from a rich family. He may be driving a car which his father has gifted him, right? So these things are possible. Or his wife may be earning very well. Your wife may not be earning that well, or your wife may not be earning at all. So look at all those factors before you worry about how much you're saving, how much you're investing. Don't copy your neighbor and say, oh, he's spending so much, I have to spend so much. It's perhaps not possible. Perhaps you're different risk levels, right? So do that. Please also understand that markets repeat. So many people don't understand what happened in the 1992 market, what happened in the Ketan Parekh scam and things like that, and how even today the same things are possible because we have not used software and computers as much as we want in banking. Very controversial, but I'm not getting into it. But go and read history. See what happened during Harshad times. You see what happened during Ketan Parekh times. And believe me, there are so many people in between, right? Go check good promoters, bad promoters. What happens is when you lose money, you sit and analyze that, right? So you analyze your failure much more than you analyze your success. When I keep looking at my success and try to analyze it, it stares in my face and say, boss, this is luck. Right, so that's also very scary, because if you made money and 3-4 pieces of luck have fallen in place, will it continue to fall over the next few years? That's a question you have to ask yourself. Also remember, learning personal finance is important. So having adequate insurance and all that is important. So you have to have a anti-fragile life, which means you have to have better volatility tolerance. So be careful about that. Connect with, is it possible for you to connect with long-term investors and talk to them? If it is possible, you will learn. So when I say, oh, if you had bought Colgate for 1,250 rupees and today you're getting 1,65,000 as dividend, people say, oh, nobody does that. You want my mother's address, I can give it to you, right? So don't say nobody does that. in this market I can find you 100 success stories and 10,000 failure stories, but there are huge success stories, and they've just done well by sitting tight and allowing compounding to work. If you can't do it, don't say nobody has done it. There are people who have done it. You can't do it. That's your problem. Thank you.